So in the video from the main credit union that I shared with you, they did talk a lot about this idea of credit or loans, and really being able to borrow money from uh, somewhere, a bank, a person, an entity, what have you. I'd like to talk very specifically about really how are credit cards and loans from a bank different. Really, at the end of the day, they're both borrowing money from someone, but they're a little bit different on how they work. So we just want to understand the differences between them. Okay. Please remember that any time that you are buying something on credit or buying something with a loan, that you are using someone else's money. Okay. In the video, they talk a little bit about the fact that this actually could be a good thing. It could be a good tool for you to be able to buy something that you maybe don't have the money for up front. I don't know about you. I don't have $35,000, $40,000 sitting around if I wanted to try to buy a car to pay out of my pocket. I certainly don't have $700,000 to be able to buy a house. So my option is either don't or borrow the money from someone else to be able to pay for that. Um, and we'll get into is that a good or a bad thing in a little while. But really is buying something now and being able to pay for it later. Okay. Now, if you remember, the rule of money states that if you use someone else's money, you have to pay for it. As I said in the video, the amount that you initially borrow, the amount of money you initially borrow is called the principal. And then you will have to pay interest on that money. So when you repay the loan, when you repay the credit card, when you repay the bank, you have to give them back all of their money plus interest. Because remember, again, the rule of money says that when you use someone else's money, you have to pay for it. So the interest is really the charge you pay to be able to use the other person's money. There is no such thing as free money, or it's very rare to get free money. So you have to pay for that, and you pay for that privilege through interest. Okay. Let's talk a little bit about the differences between bank loans and credit cards. Yes, they're both loans. They're both borrowing money, but they work differently. Okay. Number one, bank loans are what we call closed credit or closed-ended credit. Okay. Generally, what's going to happen is that you and the bank are going to agree to the terms of the loan up front. Before you actually get the money, you're going to agree with the bank on a couple of things. First, the amount to be borrowed, which we saw in the video yesterday, was principal. The amount of time you have to repay the loan. It's called the term of the loan. You will pay this back in a year, 3 years, 15 years, 30 years, whatever that is. And then the rate, the interest rate you'll be charged. All of these things you agree to up front. All right. And then you will have a set date when all that debt needs to be paid back in full plus interest. All right. So when I took out my loan to buy my car a number of years ago, we agreed that we were going to borrow X amount of money and I was going to pay it back over 6 years at a certain interest rate. So I could tell you exactly when my car loan came due or would be finished. And that is all agreed to up front, and it's in the contract and the paperwork you sign. So all of these things are agreed to ahead of time. If, for the sake of argument, let's say I took out money to buy a house. The fancy term they use in the video for a loan to buy a house is called a mortgage. They're all loans. This is a mortgage are very specifically for real estate. Let's say you decide to buy a house now that costs you $300,000. But then you realize that you have to redo the plumbing and you have to repave the driveway and you have to put in new windows. You realize you really need $350,000. But you already took out 300 from the bank. You can't go back to the bank at any point and say, can I have another $50,000? It doesn't really work that way. You would have to either renegotiate the original loan, or you'd have loan A for $300,000, and then you'd have to take out another loan, loan B, for the extra 50 you might need. Right? So there really is no changing the terms of the loan once you agree to them up front. Okay, so that's a bank loan. And typically what they'll do is, because they know exactly when you're going to repay it and how much interest you're going to pay, they will set up a schedule for you. And usually they'll figure it out and they will get you down to a fixed monthly payment every month. So you know you're going to pay the bank $300 on your car payments every single month for the next 50 months, 60 months, 48 months, whatever you choose, right? So typically fixed monthly payments that you can budget for, quite honestly, if we tie this back to our budgeting discussion earlier in the class. Okay, so that's bank loans, closed credit. Here's the idea behind a credit card. Even though a credit card is a loan, it's a different type of loan. In the credit card, we call this open-ended credit, or another term you will see used is called revolving credit. Okay, the length of the loan is ongoing. You can continue to have this loan on and on and on. I've had a credit card for many, many years. I've either had one of my credit cards for 15 years, and that loan just keeps going. Okay, you are extended what they call a line of credit. We will let you borrow X amount of money whenever you need it. Okay, and at any point in time, you can only borrow up to the amount we set for you. So if we tell you that you can borrow up to $3,000, borrow whatever you want, just don't borrow more than $3,000. Okay, so you have this ongoing amount of money that you're allowed to borrow from. Okay. It is possible that over the lifespan of you having your credit card, that your credit limit might change, and that's fine for good and bad reasons. If you are able to show that you can handle it, they may allow you to say, you know what, you've been doing pretty well. Let's give you some more money to play with and to borrow. The other thing here is the interest rate is often called variable, which we saw in the video yesterday. That sometimes the interest rate on your credit card could go up or down, during the life of your credit card. So this is a variable interest rate on your credit cards, and we'll see why that might change in a little while. The nice thing about this is that you choose first when you make payments, how many payments you'd like to make a month, and you get to choose how much you pay on that credit card. And we'll show you an example of that here in a second. So the bank loans are very much set up for you ahead of time. This is how much you owe us. This is how much you'll pay a month. This is how long it'll be for, and you can budget that. The credit card, you have a lot of choice. You have a lot of flexibility as far as to how you pay, when you pay, how much you pay. That's completely up to you. So here's maybe a scenario. If you've never used a credit card really for real, here's kind of an example of what this really looks like. So let's say your credit limit is $5,000. At any point in time, you're allowed to borrow $5,000. Okay. So you go to the store and you rack up quite a bill at Walmart and you pay $400 and you put it on your card. Great. No problem. Then now you have a $400 balance on your card. Great. As long as the $400 balance does not exceed the $5,000, you're good. And then you go home and then you maybe buy some Christmas gifts on Amazon. So there's another $235 added to your balance. Great. Here's your new balance, $635. Great. Balance still not more than the limit. Great. So you can keep borrowing against this limit as long as the balance you have on the card, the amount you currently have outstanding, doesn't exceed the credit limit. No problem. And then you book a vacation and you have to pay your bill at the hotel. Great. And your new balance is $1,800 and change. Again, you're good, but you haven't exceeded your credit limit. As long as the combined total of all your expenses does not exceed your limit, you're great. Right? You're kind of working within that window you have to borrow money and use the bank's money. The issue comes when you now try to go on the next shopping purchase, and now your credit balance could exceed your limit. Okay, so if we were to try to add this $3,400 charge into your account, your balance would now be over your credit limit. Not good. In fact, this particular transaction would not go through because that charge, that $3,400, would have put you over the limit. So that balance or that charge won't even go through. It won't be approved. In reality, if you were to stand in Macy's and try to buy all that stuff, the credit card would be rejected. because you don't have enough room in your credit limit. They would not. They wouldn't take up to 5,000 and then leave you with the balance of 223 to pay somewhere else. No, that whole charge would just not go on the card, because you're not allowed to spend more than your limit at any one point in time. Okay, so here's really that difference between the open-ended credit that credit cards are and the bank loans, which are the closed credit. Bank loans, this fixed one-time deal, you agree to borrow this amount of money and then pay it back to us in a certain amount of time, versus credit cards where it's this more open, yep, use this money however you want, use it as frequently as you want, use it as little as you want, just don't ever ask us for more than the limit. Okay, so really two very important differences here about really types of loans: your closed-end loans versus your open-ended credit. Important difference here to just pay attention to and to know about.